Bond yields continue to gallop ahead, and some would say they're galloping with reckless abandon. Think about this, folks. The 30-year just hit 3% yield for the first time since 2019, breaking through a 4-decade-old trend line. Now, it's not just that these bond yields are higher, of course. It's the pace in which they're moving. I mean, it's jarring, and yet there are a lot of questions on what it really says about the economy, what it means for investors. I want to bring in from Bianco Research, the president, Jim Bianco. And Jim, I read where you pointed out $2 trillion lost in domestic bonds, $5 trillion in global bonds. And it just seems like the stuff of black swans. What are the implications right now?
Yeah, the bond market, the sell-off in the bond market, because yields are very low, they don't compensate for the price, and you wind up as a bond investor losing a lot of money. And you'll hear it all the time, that there is no alternative to the stock market, that the bond market is a bad place to be with the rising inflation. All that's true. But eventually, at the end of the day, the bond market is going to have to get funded. And the way it'll fund itself is it'll drive interest rates so high, it'll make it a compelling investment alternative to everything else. Now, we don't want that to happen, because driving interest rates so high to make it a compelling investment alternative kind of sucks the life out of everything else, because, interest rates get to be this burdensome level. So we have to be careful with the bond market. It's okay if rates go up because the economy's expanding, but if rates are going up because we have inflation and no one wants to own bonds, that will eventually turn into a problem. Yeah. And I fear that problem might be sooner rather than later.
I spent a lot of last year talking about the 60-40 portfolio, 60% equities, 40% bonds. What happens to people who have really loaded up on bonds? They're 55, 60 years old. They did well in the stock market, thought they were shifting into something that was unstoppable for 4 decades.
Yeah, the 60-40 portfolio was a tremendous investment strategy until about a year ago. And what happened about a year ago was inflation. And technically what happens is bond prices and stock prices start to move up and down together. Prior to inflation, they move opposite, so they tended to be a natural hedge for each other. So as they move up and down together, the problem is when your bond portfolio doesn't work, which is this year, your stock portfolio isn't doing much. Stock market's down 6 or 7% for the year, so it's not doing much as well. And when both of them work, when one works, the other one works. So the 60-40 portfolio is turning out to be a lot of indigestion and heartache, because it's either a boom or a bust. It's either both sides are working or neither side is working, and right now neither side is working.
It's one heck of a bust. All right, now you tweeted the biggest story that no one's talking about is this pressure building in the Japanese government bond and currency markets. Now, why would that be important to, let's say, an American investor in Butte, Montana?
The Japanese are the largest country owner of Treasury securities, larger than China. We always talk about China, but Japan owns 1.3 trillion, China owns 1.1 trillion of Treasuries. Interest rates are heading up in Japan because of inflation. The Bank of Japan, their central bank, is forcing them to not go any higher, and that's weakening their currency. It's not that they don't want a weak currency, they just don't want it to weaken this fast and this much. It could create problems for their economy. It could create problems for their banking system. It could also divert money away from the U.S. Treasury market because they're such a big buyer. And it could come at a time when interest rates are already going up because the Fed stopped buying and we've got inflation. All these things happen at the same time. The Fed stops buying, we have inflation. Japan is starting to feel the strains of inflation as well, too. And it's all working towards what we talked about earlier, rising interest rates. And if they have to rise a lot to find another buyer, be careful, because we might not like the interest rates we're going to go to.
Hey, Jim, I got 20 seconds. So it sounds like we just stay in stocks for right now, maybe commodities for right now?
If you want to play for the higher inflation, that's a good play. I think the commodity-based in stocks as well, too, and the safe cyclical kind of stocks. The racy stuff, I think, is going to really struggle in this environment.
Jim, it's great seeing you. Talk again soon. Thank you.
Thank you.
All right, folks, coming up, my take on student loan debt forgiveness and why it's